What if Bitcoin's biggest risk isn't regulation, volatility, or even government hostility, but the fact that it's being pulled directly into the very financial system it was designed to escape? What if the next phase of Bitcoin adoption doesn't come from retail believers or cypherpunks, but from balance sheets, mandates, and institutional capital that can't actually own Bitcoin at all? And what if the most important shift happening right now isn't price-related, but structural, quietly reshaping who gets exposure, who doesn't, and who captures the upside over the next decade? In a recent podcast conversation, Sam Callahan unpacked global liquidity, government debt, Bitcoin ETFs, and the rise of Bitcoin treasury companies, and why these trends may accelerate adoption while simultaneously introducing entirely new risks most investors aren't prepared for. If Sam is right, Bitcoin's next chapter won't look like the last. And understanding these mechanics now may be the difference between compounding wealth and missing that it's becoming the base layer of a financial system that no longer works the way most people think it does. Hello, everyone, and welcome back to another podcast summary video. In this episode, we're breaking down Sam Callahan's recent appearance on What Bitcoin Did, a wide-ranging conversation that stretches well beyond Bitcoin and into the mechanics of debt, liquidity, capital access, and systemic risk. The discussion starts slowly and deliberately, with Sam laying out why understanding today's markets requires stepping back from narratives and focusing on structure. This wasn't a price prediction episode at all. It was a framework episode that explains why assets behave the way they do in a world dominated by government deficits and central bank intervention. This podcast episode runs for over an hour, but we've distilled the most important ideas into a single narrative so you can grasp Sam's arguments without listening to the full conversation. If you find these summaries useful, please like the video, subscribe to the channel, and share your thoughts in the comments. It genuinely helps keep this content going. Now let's walk through how this conversation unfolds, starting with the real foundation of today's financial system. The conversation begins not with Bitcoin, but with debt. Sam explains that government debt has reached a scale where it no longer behaves like a background variable. It actively shapes markets. In the United States alone, federal debt now exceeds $34 trillion, with annual deficits running between $1.50 and $2 trillion even outside of recessions. At this level, traditional policy choices disappear. Raising interest rates, too much risks destabilizing government finances. Cutting spending is politically toxic. That leaves monetary accommodation as the default path forward, whether policymakers admit it or not. This is what Sam refers to as fiscal dominance, a regime where central banks are no longer free actors but are implicitly forced to support government borrowing. Once you understand this, market behavior starts to make more sense. Bitcoin enters the picture here not as a speculative bet, but as a response to a system that cannot deleverage without breaking itself. From there, Sam reframes Bitcoin volatility in a way that challenges most narratives. Bitcoin doesn't move randomly, and it doesn't simply track risk sentiment. It follows global liquidity. When liquidity expands, Bitcoin thrives. When liquidity contracts, Bitcoin suffers first and hardest. This is why Bitcoin often crashes before equities and recovers before them as well. It's not a flaw, it's a signal. Sam points out that Bitcoin is one of the most liquid assets in the world, trading 24/7 with no circuit breakers. When stress hits the system, Bitcoin becomes a source of liquidity rather than a refuge, at least in the short term. This confuses new investors, but also reveals Bitcoin's true role. It reacts instantly to monetary conditions, exposing shifts in liquidity long before traditional markets catch up. One of the most eye-opening moments in the conversation comes when Sam discusses how much capital cannot buy Bitcoin, even if it wants to. Globally, there's over $100 trillion in institutional capital constrained by mandates, regulations, or jurisdictional rules. Pension funds, insurance companies, and sovereign pools of capital often cannot hold spot Bitcoin, but they can own public equities, ETFs, and structured products that provide indirect exposure. This creates a strange dynamic. Bitcoin itself remains scarce, but access to Bitcoin becomes even scarcer. When capital finally finds a compliant path in, it doesn't trickle, it floods. The implication is subtle but powerful. Future demand for Bitcoin may be driven less by belief and more by necessity. Sam emphasizes that capital is not as global as people assume. Despite the internet, money still moves through national rails, shaped by local regulation and tax policy. Brazil illustrates this perfectly. Local investors effectively have access to one major Bitcoin treasury company, one primary ETF, and a small number of public proxies. Pension funds cannot own spot Bitcoin, but they can own these vehicles, and that concentrates demand. Tax policy deepens the distortion. Spot Bitcoin gains in Brazil can be taxed up to 22.5%, while equity gains sit closer to 15%. That difference alone reshapes investor behavior. Scarcity, regulation, and tax efficiency converge to create premiums. Not because of hype, but because access itself becomes the scarce resource. This leads naturally into the discussion around Bitcoin treasury companies and valuation. Sam is clear, trading at a premium to net asset value is not a birthright. It's something that must be earned. A company justifies a premium only if it can reliably increase Bitcoin per share. That means issuing equity above NAV to buy Bitcoin accretively, repurchasing shares below NAV, or using leverage intelligently and conservatively. But leverage introduces fragility. Rising rates, poor timing, or aggressive dilution can destroy shareholder value, even if Bitcoin itself performs well. Bull markets reward boldness. Bear markets punish incompetence. In Bitcoin, execution is everything. One of Sam's strongest warnings comes when he contrasts owning Bitcoin with owning Bitcoin companies. They're not the same exposure, even if they feel similar during rallies. Bitcoin removes counterparty risk. Treasury companies reintroduce it through management decisions, capital structure, governance, and leverage. These risks don't disappear just because Bitcoin goes up. When investors sell Bitcoin to buy Bitcoin equities, they aren't upgrading exposure. They're layering risk back into a system Bitcoin was designed to escape. That trade can work, but only if investors understand exactly what they're giving up in exchange for convenience and optionality. The conversation ultimately settles into a clear hierarchy. First comes understanding Bitcoin, then comes owning Bitcoin. Only after that should investors consider layers built on top: ETFs, equities, or derivatives. Treasury companies weren't optional. They were inevitable. They unlock trapped capital, expand access, and integrate Bitcoin into legacy financial systems where direct ownership isn't allowed. But they don't replace the base layer. They depend on it. And every layer added above Bitcoin introduces new points of failure. If the world continues down the path Sam outlines, persistent deficits, monetary accommodation, and financial repression, Bitcoin's role becomes clearer, not weaker. The real risk isn't missing the next rally. It's misunderstanding where the foundation actually lies.